management accounting, as we discussed in the start of our session, that your advanced management accounting book would be getting you familiarized with the concept which you would be using to make the various type of the reports. You would be doing the various type of the analysis, which will help you to take the decisions. So this managing performance was focusing on the business model side. It was focusing on the people and the leadership skills. It was focusing on the aspects of the project and the project management and the various type of the attribute which a project manager needs to have in order to perform a project effectively. Now, this advanced management accounting book would be talking about the various type of the concepts which will help you to see the cost structure of your organization, of the business model typically that you has deployed. What is the cost structure of that business model, how you are analyzing, and it will help you to that how you can analyze that. And as we know that in a today's competitive business environment, organization have the little control over the prices. So therefore the organization are focusing lot more on managing their costs. So value for money is a concept like whatever the services or products are being delivered to the customer, the customer should feel that whatever they are paying, that is value for money. Whatever they are getting, that is value for the money that they are paying to the organization. So in order to understand that, this advanced management accounting book starts with the first concept of activity based costing. So when we say that what is the cost structure of your organization, it means that we are talking about the cost which is being incurred during the process of the value creation. We studied about the business model where we were defining the value and creating the value and delivering the value, right? So while we would be creating the value, we would be performing certain activities. We would deploy certain process. You have seen that we would be utilizing certain resources in the previous book. So I'm creating a link. Case study is the integrated study. So you know that you should understand the concept in an integrated manner. So in a business model, you have seen that the resources would be deployed through the various processes by performing the various activities to create the output for the stakeholders. So those processes and activities would be those activities you have seen that the process those activities would be incurring certain cost. There would be a portion of the cost which is directly like known. You could know that the direct material, direct labor, etc., which is being consumed by a certain activity. But then there are the overheads which would be used by your products and the services. And nowadays, the businesses are not just offering a one product or a one service. The organizations uh, understand that there are the different market segments, and the different market segments have the different requirements. So they are offering a range of the product and the services to the customers. So now, in order to create those services or the products, the various activities uh, would be performed. Um, can you please just hold for a second? Just 1 second, please. Okay, I'm sorry. So, you know that those active, there would be various type of the overheads that your organization would be incurring. So, we will have to see that traditionally what we do is that we distribute those overheads among the various, the products and the services at the bottom of our P&L, and that is like clubbed together. So we cannot differentiate that how much overheads has been consumed by which activity, and obviously those activities are being performed to create the services for the manufacture the product for your customers. So this activity based costing actually tells us that we need to have an understanding that what are the the various activities being performed to create or generate these services, and how much of these activities how much of these activities are using the resources of your overheads, especially overheads. So that will help us to understand that if I am producing product A, B, C, or and D, so I should have an understanding that how much cost is being consumed by the A, B, and C, and accordingly, then I would be in a position to know the profitability from each type of the products. When in organization we keep the overheads clubbed together and we don't trace the consumption of those overheads and link it to the various activities, and then those activities with the various products for which those activities are being performed, we cannot get the clear understanding of the cost structure and the profitability of a specific product or a service. So the idea here is that if your organization is just producing a one type of a product, then you don't need to perform perhaps the activity based costing, because you know that all the overheads are being consumed by that single product. But if you are producing a range of product, then it becomes important, because this will give you an idea that how much uh, each product is profitable for your company. So that will help you to then take a decision that maybe you should focus on the products which are giving you more profit. You need to focus on those products more compared to the products which are giving you the less profitability, or you might even decide to discontinue that product line because that that is not profitable, and that is using a huge amount of your resources, yet not creating the value for the company. So this activity based costing, this whole diagram talks about that thing, like those that you it's a backward thing, like you do have the product and services. These product and services are created or manufactured, generated, whatever that, it depends on the type of the thing we are talking. Using the activities, those activities are consuming the resources. Those activities could be like just example, mean machine setup. These are now the overhead, product design, etc. And then resources are being consumed by these activities, and these resources are like the factory overhead plus selling general, the overheads various type. It depends, it's just a few example, like it depends on the nature of the business and the type of the overheads you do have in your organization. Similarly, where you do have a service business like in banking or other the areas, then you could do the same thing for the customers, like how much each of the customer is using your overhead, consuming your overheads. So there is a rule we're going to learn about, that 80/20 rule. You will see that 20% of your activities would be consuming 80% of your cost. So you would focus more on those activities, and then you could manage them more effectively in your company. We're going to see that in a pre-scene analysis as well, that you do have the different divisions which are performing the different tasks. So there are the overheads which must be being used by those activities while generating the value for the customer in your company. Happy well. We will talk about that in a little detail in our pre-scene analysis. So this is the concept of the ABC, and the idea again is to understand the cost structure. My again point is that activity based costing will give you the breakdown. it will give you the understanding. In itself, it doesn't help you to improve the cost. Then you will decide that which product needs to be continued, which activities need to be reduced. You will decide that. It will just give you an idea about the whole cost structure. So activity based costing, it's benefits of using it, like if as I already told you that that it will be giving you a detailed idea. You could see that that the competition, in a competition especially, which products are performing well, which are not performing well. And then you could product customization could also be a one aspect which could be understand that if you are doing a product customization, so you could see that how much benefit you are getting from it, and how much cost you are incurring on it. These are the few of the benefits of activity based costing. The idea again is that you will understand the cost structure of your company. You will see that how much cost is being incurred on each type of your company's product. Disadvantage is a detailed work. It needs a specialized knowledge. Sometimes it becomes so difficult to trace the cost associated with the various activities, because the consumption of the resources or the overheads is such that you cannot differentiate that that which activity is utilizing how much or consuming how much of the resources. So heavy use of information technology, time consuming, these are the some of the disadvantage. Then that this is the about um, the product or the service that you are using. Now again, we could do that for the customer profitability. As I told you that in some of the organization, like banking is a classical example, banks are classical example, that where you have a various type of the customers, and those customers are in a bank, the time of the manager, the time of the other human resources is actually the resource. So you will see that how much resource is being used by each type of your customer. Sometime that if you are not using your bank account for a long time, they will make it redundant, and because maintaining the account in a bank requires certain resources, so they will see that that this is through customer profitability. You could know that which customer is giving you how much profitability. In many organizations, these corporate customers get a lot of importance. Why? Because they are giving you the more profitability. So do the organization have this specialized, the account manager for to maintain the relationship with those customers? Whereas for the individual customer who is not a, that is not a is not giving you so much business, so you will be managing your resources. So in organization, custom understanding the customer profitability is very important, and you would see that 80% of your revenue would be coming from the 20% segment of the customer. So the idea is that you need to channelize your 80% resources to those 20% customers to optimize your business and to make it more effective. So analysis of revenue stream and services cost associated with the specific customer or customer groups, you will analyze that. And we would be applying the 80-20 rules. As I told you, that you will be channelizing the resources to those 20% customer, because those 20% customers are giving you the 80% profitability. Again, this could be done by breaking down your whole structure. Then this holds true for the distribution. Now again, you should understand that here we are trying to understand the cost structure of the organization, because this book will start by explaining the concept related to the cost. Cost is very important in today's environment, because the price is many a times is dictated by the market, not many time, all the time dictated by the market. You can't do much about the price. Now even in today's world, when the customer have a lot of information, they could make the comparison. So on the price, you do have not so much margin. So what you need to do is that you need to make the improvements in your cost structures. So at a market price, you will keep your cost low, so you could create the margin for your stakeholders, so you could deliver them the value for the customer, for the shareholder, for the employees, right? So again, in order to understand that cost structure, we know that the cost is being incurred in various activities. So here the customers, you are incurring cost on directly on the product or services, then in directly on the customers, And the distribution channel is a one part where you would be incurring the cost. That is very important in your case also. And that is more or less your organization would also be having the same type of the distribution channels. uh, you do have the customers, you do have the individual player group, business group, religious tourism, etc., etc., and you do have the different channels. You do have your own offices, retail. You are selling to the retail agents. You are selling to the direct channels online, right? And specialty channel, or it depends, which is there is a specialty, a dedicated line for the gold customer. Sometimes that the priority line, so they might be having a different channel. And the supplier of transportation, so you could imagine that your company is also being in a business or tourism providing these services. So all these channels have a different cost structure. Nowadays this channel is emerging, and that has been explained in your case study pre-seen as well. Online distribution, these are cheaper, efficient. A customer is the approachable to you. It is convenient for the customer to use it. These channels are you do have your own setup, physical setup, that is more expensive. You do have the human resources there. But now these channels are decreasing. The desirability for these channel is decreasing. It's going down. It's on the downhill, right? And that's why we need to see that which of the distribution channel is costing you how much, and how much it is giving you, paying you in terms of, or getting you the market share. So that will help you to then focus on the distribution channel which is giving you more the margins. Now, talking about when we are talking about the cost, and we have, as I told you, that activity based costing is going to get you an idea about your cost structure. In itself, it doesn't help you to improve the cost structure. ABC, there is a historic information, there is a historic proof that it doesn't help you to improve the cost in itself. Now, once you would be having a clear understanding, you could use the various techniques. Then that is the TQM one technique which could be applied um, to optimize your cost. I will say that optimize your cost. It is not like that always you would be reducing the cost. Optimize means that you would be shifting the resources from the one activity to the other, so that in total you would be consuming the same but optimized, right, after having the understanding of ABC. So similarly, this the total quality management, what is this concept? And that, by the way, improving your the production system and reducing your cost is imperative, because you are facing a global competition now. Now, even if you are not operating at a international level, you still facing the competition. For instance, you are operating here in our country, but you have to compete with the product which are being produced in China, and the cost there have a very competitive cost structure. So you need to improve, even you are not operating at an international level, right? So cost of the two basic principles of TQM: get it right first time through the trainings, through the the induction, the quality employees, inducting the quality employees, having the good procedure processes, that will help you to have the get it right first time. Cost of prevention is less than the cost of correction. So you will be taking all measures. Like training is considered as one of the technique. Then continuous improvement. Dissatisfaction with the perfection is nothing. It is a continuous process. So there is a continuous improvement, and you want to achieve the target of the zero defect, or whatever your the product or the processes in your company. We can apply that concept, you would be selling the generating the services, applying the quality management, because airline is being operated by your company, hotel is being operated by your company. So TQM is quite relevant with your case study. The cost of quality, then there are the two top types of the cost of quality. One is the conformance, and the other one is the non-conformance. Conformance means that you are conforming. Conforming means that you are complying with something, and you are when you are complying means that it's a proactive approach. It's a proactive approach. Prevention cost and appraisal cost. Prevention cost means that you will be taking the measure which will help you to stop happening that event which could create a waste, like the quality training, building of quality into the design and manufacturing processes of your company. That will be helping you, that then you would be determining whether quality factors have been correctly engineered into your design about those processes, that we studied about the processes. So process optimization is a process, is a kind of activity which help you to uh, prevent the defects, so that help you to then maintain the quality. So then appraisal is that once the product has been produced, so you could there is a quality control department which would be appraising, well, that then on products there is a sticker of QC. That means that it somebody has checked it. Non-conformance is internal failure, external failure. Internal failure at a control quality control, you have got to know that there is certain products which are not meeting the requirement. In our market, you must have seen that some of the products are being sold. Those are meant for export, and this tell that it is a leftover because of certain defects. That is the poor performance, evidence of the poor performance. That it means that the whatever the lot was being produced or the order was being produced, certain products. Certain items did not meet the criteria, and because of the internal failure, that has been not exported, and now that's being sold here at a cheaper price. External failure, when it product reaches to the customer, and now the customer came back to you for claiming for the warranty or the guarantee. That is external failure. So a TQM has been tested quite a number of times in the exam. So I have just given a little brief on it, although it's not complicated. Uh, Steps to implement the TQM in your company. These are similar for all the type of the companies. You will just relate it with your situation, a question situation, total commitment throughout the organization, get close to customer, plan to do all job right first time, agree expected performance standard. Now these are the the things like when you are a manager, you will do that. Like you will be communicating these required standard clarity to your employees. That is one of the the first step, or you could say the prerequisite. Implement a company-wide improvement process, continuously measure performance level, measure the cost of quality, mismanage demand, continuous improvement in everything, and recognize the achievement. That is very important. That would be keeping the employees motivated. So these general things you could come up from your own side, because this is not something mathematical. There could be some more, the ideas which could help us to implement the TQM, make quality a way of life, like it should be embedded in the culture. Then a TQM, there is again a systematic process which could be applied to achieve the quality of the objective of the TQM. Uh, that is like design process. We studied about that design optimization, process optimization. Embedding the quality in the measures in your process. Then manage the TQM. You will be managing it like by taking the prevention measures, conformance and non-conformance. Then pull a Kanban. It depends. Some of these steps would be applicable in one situation, and some of the ones would be applicable in another situation. A step like Kanban is for the pull, like you would be having a system where you would be ordering once your inventory level has reached to a certain level, because you don't want your company to go out of a stock, right? Then establish vendor relationship, fine tune inventory skills and capability. Again, I'm telling you that you could come up with some of the steps from your own, from your side as well, from your practical experience. But generally speaking, you should know that what is the idea of the total quality management. Then another concept in managing the cost effectively is the business process re-engineering. Now business process, because we are talking about the process, because if your process is flawed and it is not efficient, whatever you do, that's not going to help you. That is the problem with the organization which have not adopted the new technologies, the digital. Now the digitization. What is the digitization? That is the process re-engineering. What is the ERP? That is process re-engineering. We are changing our processes fundamentally. in many of the state-owned organizations, you would see that the processes are so cumbersome, so lengthy. So those needs to be re-engineered in order to make those organizations effective. Whatever the measures they are taking, those are not, those are not effective. Reason is that the processes in itself are so cumbersome. So business process engineering is the act of recreating the core business. So you are challenging the fundamentals, right? Process with the goal of improving product output quality and reducing cost. So it involves the analysis of company workflow, um, finding processes that are subpar or inefficient. If you have ever been a part of a ERP implementation project, you will see that they go into the details of every process, because that process then would be created in the ERP. So they will optimize it, they will make it efficient. So define objective. It is not like that you would be doing it only for the ERP. You could do it for any type of the. I'm just giving you an example. So defining objective and the framework, defining customer needs, study the existing products, formulate a redesign plan. If you see a question in exam, you will just writing the answer under these guidelines. Formulating a design redesign plan and implement the redesign plan. So and you what you need to understand is that the value engineering or this process re-engineering, business process re-engineering, these are the processes. This is the technique which fundamentally challenge the process, right? So it will help you to understand that which processes are adding the value and which of the processes are not adding the value, and accordingly you will be re generating the process, you will be re-engineering the processes, right? So target costing, then you know that after knowing the ABC, after knowing the quality management concept, that how we could apply these concept to optimize the cost structure in organization, what we want to achieve, that we want to achieve a certain cost, and that concept is called the target costing. Now the target costing is that, as I have already explained you, in organization, uh, you have a little control, or you have an absolutely no control over the price. So what you can do is that your control is limited to the cost. So there is a new concept like target costing. So target costing means that you will get to know that in the market the product or the service is being sold an X price, and in order to generate a revenue of $2, I will have to produce that product in X minus 2 price, right? If X is 10, you will have to produce that in $8 in order to make a profit of $2. So that is called the target costing. Now the target costing idea revolves around that in your uh, processes, you know that when a business is running, there is a little margin that you could improve the cost. If you know that if the product has been designed in such a manner that it would be increasing the cost, then you cannot do much. So what they are giving you, the idea is that when we are designing, when we are planning the concept of a product or a service, that is the time which will which will define that how much cost you will incur on it. So if you are making a product like an airplane, for instance, when you are buying the airplane or leasing the airplane, if you have decided that you will be having the seats like with the ample or with the generous seat pitch, you would be having the little number of seats, less number of seats in your airplane. So now at that time, you will have to decide that you need, because you are a leisure traveler, you are catering for the requirement of the customer going for the leisure travel. They don't need much leg space. You need to just comply with the regulatory requirement. You could make it comfortable, but not generous seat pitch. So if an airplane has been inducted or bought with this configuration of the seat, you cannot much then do. You cannot do much about it. So detailed design means the planning and concept design, cabin service, hotel accommodation. I'm just telling that if you have built a hotel with a swimming pool, sauna, and all those facilities, so now you cannot sell it cheap. So if you want to keep it a value for money, you will be giving the services, but those are the services which are important for the customer, and then you would be making the charging the price accordingly, right? Then detailed design, level of service in flight and at all. While you are, again, the idea again that you generally need to have an idea that while you are creating, designing the product or the service, that is the time when your 80% of the cost would be committed. So if you have decided that you are going to manufacture a mobile, you have created a design where its camera would be having 200 megapixel, then after production, what you can do, you will have to have the 200 megapixel camera. That would be expensive, so you could not change it. So at the time of design concept, you need to define that what type of the what type of the product you need to have. Then the target costing, again, it's an important topic and tested numerous times. So I have just gone into a little bit detail so you could read it. So even if you don't read the book, you will get an idea. Target costing is a part of product development process. It starts with understanding the want and need of customer segment across targeted competitive market and the price they are willing to pay for the product and its variant. Business must specify the margin it needs to get maximum tenable cost for the product. The margin needs to be sustainable across the product's full expected life. Because target costing compasses a business full cost, it applies to its full value chain, all the processes from design till delivery to the customer, even feedback till feedback from the customer. Everything will have to be seen because even in distribution channel, you are incurring the cost we have seen. So at one end of the value chain, customer value must be expressed in terms of value, the product and its variant generate. So you know that this is the idea that again the idea is that while you would be designing or when you would be conceptualizing about a product or a service, at that time you need to decide that what type of the product that would be or the service that would be, because that would be defining the cost. Then the concept of the value engineering, that is related with again the cost structure of your product, to how you could manage the cost. So value engineering is used in target costing to reduce product cost by analyzing the trade-off between different type of product functionality and the total product cost. Now, whenever you are adding an attribute in your product or a service that is performing a function, like in mobile, if you take the example, you are adding a camera. So what is the functionality? Customer wants to take the picture. You are adding a good speaker. What is the functionality? So the customer could listen the voice clearly and they could play a music as well. So now we will see that the customer is more concerned about the function, not the the what we call that the attribute of the product, or the specifically that the typical item that you are adding or a part that you are adding. So if that functionality can be achieved with a lower cost, you can do that, or not compromising on the quality, but you can do that. Like a camera is inside, if a very good camera by an unknown brand is there, and there is a camera with a brand with very good famous brand, there the one cost more, the other less, so you will go for the less because the customer would not see it, but till such time the quality is good. So an important first step in value engineering is to perform consumer analysis during the design stage of the new or a revised product. So you know that you would be doing at a design stage that, as I told you, that at a design stage the cost would be committed. So you need to see that the functions are the functions are provided in the most the reasonable or the most optimized cost. And while we are talking about the value that the product is creating for the customer and we do here the value analysis, we need to have the understanding of the different type of the value, cost value, the value that you are incurring, that is in your control, like you will be controlling it, because now you will see that how you're going to optimize the cost to deliver the value to the customer. Exchange value, the customer, how much customer is willing to pay for that product or service, is the exchange value. Now exchange value is irrespective of your cost value. How much cost you have incurred to produce that product, that is not a concern of the customer. They would think that exchange value, that if it is a value for money, good. Use value, this is related to entirely to function, like the ability to product to perform its specific intended function. Utility, so that would also be defining the value. Then esteem value for the differentiated products. The people feel good like having a Rolex, so that is a esteem value, so they are ready to pay for it. Now it depends that where you fall. Like most of the companies fall like they would be following that exchange value concept, that how much the customer would be ready to pay for their product. Now in a value chain analysis, we have seen that this target costing concept is not just limited to the design and product concept level. No, there is a whole process like we studied here, like R&D, design, manufacturing, and customer services. So the concept is throughout would be implemented throughout the value chain creation. So now in a value chain, in your industry, there is a tourist, like there is a distribution, international transport, and then distribution for the inbound country, outbound from your country going to the other country, inbound coming to your country. So there that is like this is the value chain. We are not going to into that typical value chain concept. It is just to give you an idea that when a customer is going outbound distribution, like travel agent, tour operator, independent, online, airline, international transport, your airline, then the cruise, you don't have the cruise, then the distribute inbound, again they would be taking there in that country, uh, the national travel agent, like if you went into a country and you want to travel within that country, so then there is a different now the thing. So we're gonna go into the detail, we're gonna learn about these concepts, this value chain in your pre-scene. So life cycle costing is that the customer is concerned about the total cost of the product from its purchase till it has been discarded, or that disposed of. So for the organization, they also need to understand that they would be focusing on the life cycle costing, starting from the research till after sales service. When we buy a car, we just don't consider its initial price. What we do is that we talk about its maintenance, fuel consumption, etc. So life cycle costing. Similarly, organization would be looking at the product from a customer perspective. So from an R&D to design to production, and then marketing, distribution, at each level you would be incurring the cost. But the idea here is that, which needs to understand, is that when you are doing the research and development and design, this is the time you will be committing most of your cost, like 90% of your cost is committed here. Now even you are trying to optimize your function processes here, that would not helping you a lot. Now if you have designed the project in such a manner that makes it expensive, or that it is incurring more cost, then here you would be having a little margin to improve it, right? So again, the idea is that we would be focusing on the life cycle costing, and in life cycle costing, focusing on this R&D initial phase of design phase, that is very important, right? As I've given you the example of the mobile. So and now that after having the understanding of the cost structure and the various type of the cost which your organization could incur, uh, we have also studied about the techniques which could be used to improve the cost. This is the cost part. Now we have the understanding of the cost structure. So when we would be performing the appraisal, like introducing a new product in your for your business, or going for a new venture or a new opportunity, we would do the analysis of that project investment. That is called the capital investment. So in a typical capital investment process, there would be an opportunity that would be identified. We would be evaluating that uh, opportunity. Now, identification, like they have told us that the type of investment could be require replacement investment, expansion and diversification. These are again are the couple of few example, not exhaustive list. Then evaluation, we would be evaluating it by like knowing the different cash flows. We would be doing the forecasting, etc., etc. Then the selection, we would be applying a evaluation technique like NPV, IRR, and then implementation and follow up, like we would be implementing a project and then we would be analyzing that how that project is performing. So that is the capital investment process. So in order to identification and evaluation, you will have to find the, after identifying the opportunity or identifying the investment which you want to make, you will have to find the data. Now, for the data, when we are collecting the data, there would be a lot of sources for the data. You could have a data from your internal resources, from external resources, because you know that in a typical investment process, you would be forecasting the revenue, you would be forecasting the cost, and cost would include the various items there. Some of the you because your organization is already operating, so we need to have an understanding of the various type of the cost which should be considered while making the decision. Because if we would be not if we would not be clear about that which cost needs to be taken into account, we might be reaching to a wrong decision. So future cash flows, cash expenses that will be incurred, avoidable cost, uh, you know the cost which can be avoided if you don't do that project. Opportunity cost, cash inflow that will be sacrificed as a result of a particular management, you using your own premises. uh, so if those can which can be rented out to a third party, that is the opportunity if you're using it for that project. Incremental cost, like the additional cost. So same non-relevant sunk cost, committed cost, non-cash expenses, these are the sunk costs. You could have a review, because it's not again complicated and I will not going into the details. So the idea is that while you would be doing the project or the investment appraisal, you need to have an understanding that which cash flows need to be taken into account. So while we are making the investment appraisal decisions and appraising the project, it is not like that we would just be focusing on the financial aspect. We would be taking into account the non-financial aspects as well. So we will see that how that project is having an impact on your other, the non-financial performance indicators, that whether how that it will help you to improve the human capital, or it will help you to dispose of the corporate social responsibility. Is that investment increasing your intellectual capital, how that project is affecting the environment? These are also the important that needs to be taken into account while you would be making the decision with the financial information. Now, in order to understand the concept of the investment appraisal, we need to have the understanding of the time value of the money, because all of the investment, most of the the widely used investment appraisal techniques use the concept of the time value of money. NPV, IRR, this time value of money concept is important. So time value of money concept is simple, like simply put, like it is time value of money is defined as concept which states that purchasing power of money differs with the passage of time. So a dollar in hand today would not the dollar in hand today worth more than the dollar in hand which you might have 5 year down the line. Because of the inflation, because of the risk and various factors. So reason for of this concept, like if you give a dollar to someone today, you and that the person tell you that they will give it back to you in 3 years, do you think that you will agree? No, because you will tell them that I don't know, first of all, whether you will give it back to me after 3 years or not. Risk. Then in $1, I can buy various things today. The same amount of quantity could not be, I would not be able to buy 3 years after, when you would be giving me that dollar back. And then these are basically the interest like factor is also like you, if you put it that in a bank, you will get the interest and you will make some money out of that dollar. So that is another factor. So you will say that I will give you a dollar, but I will get 10% return on it every year, right? So this is the basic concept of the time value of the money. I hope you are already aware. Then the investment appraisal techniques, NPV, again, I'm telling you, you would not be doing the calculation there. You need to have the conceptual understanding. So NPV, IRR, payback period, profitability index, or the techniques. NPV is the net of the present value of the cash inflows and the outflows. Net, from name it, you could see that. So discounted inflows, discounted mean that there is a discount rate, time value of money, because of the concept of the time value of money. Some, if you are invest in a project today, you will tell that because of these factors which we have discussed, I want a 12% on it. So if you would be raising the finance from the bank and from equity holder, they have a required rate of return. So you will the determine the weighted average of that uh, returns, and you will discount the inflows and the outflows accordingly, and you will net that in order to understand the net present value uh, of that project. Like, right, then IRR is another technique. NPV is the most widely used. IRR is another technique, internal rate of return, where the NPV becomes zero. Payback period, like how long it will take you to get your money back. Then the profitability is a very interesting, like when you do the finance says that all the NPV positive NPV projects would be adding value to the stakeholders, so you should accept them. But you do have the capital rationing concept in the organization. You do not have the unlimited resources. So profitability index will tell you that how much is the profitability of the each product in terms of that in terms of its initial investment, like vis-a-vis its initial investment. So if you have 5 projects, you will see that if you have a constraint of resources, you will see that a project with a higher profitability index would be taken if you do have the enough resources to conduct that project. ARR, accounting rate of return, again is not widely used. It is calculated by dividing the expected income from investment and cost of that income. Then with these financial factors, as I told you about those non-financial factors which are related to the, that is called the integrated, the integrated reporting part of the organization performance. Now with that, there are certain other options as well, or the the things which need to be considered, real options. So in some of the project, you will be having an option to expand, like an airport you are developing. If you will be going for a project which can be expanded in the future, if there is a requirement of a growth, you can expand it. Abandon that option to abandon, like if in between the project you find that the project is not viable economically, you could abandon. You need to have the option to abandon it. Option to wait, it allow business to defer a decision for future date. Uh, you do have the wait, you can wait for the project, like I mean, you do have the option to wait for the project. Like some of the investment, you need to make the investment today, or it will opportunity will be gone. But there is another opportunity where you do have the time, you can think for 2 months before making the investment. So the time is also important. That is also considered as a plus thing project, because during that 2 months time period, you could think about it. And then option to contract, this option enable a business to close or shutter a project at any time in the future if the external factors are not favorable. Then option to redeploy, that you are making a hotel building, and it in like while you are doing the project, you found that it is not a viable option, so you could convert it into a residential building, right? Now from the this this point, investment appraisal, we were talking about the cost. We were talking about the various techniques to manage the cost, and we talk about the project appraisal. Although project appraisal doesn't include the cost only, however, the cost is a major project part of your project appraisal, because the revenue is a one stream. Like you do have the number of units or whatever your product is. You made the forecast. You have a projected price. You multiply it, you will get the revenue. The major portion in project appraisal is about the cost. There are 1,000 items related to the cost which will have to be taken into account in order to determine the relevant cash flow. So you know that in your these cash flows, relevant cash flows, we have studied about those. All the things are related to the sunk cost, avoidable cost, opportunity. All are related to the cost. Why? Because cost items are much more than the revenue items. Now, till the sixth chapter, we or this investment, this that's the sixth chapter in advanced management reporting, advanced management accounting book, that talks about the investment appraisal. That's related more to the cost. Now, from this onward, we are talking about the revenue. So, revenue pricing decision, how you would be making the pricing decision. As I told you that in project appraisal, you would be having the revenue as well, cash inflows and outflow. Inflow is the revenue. So revenue comes from the price, number of units, and the price of the unit. So how you determine the price of your product and the services? The pricing decisions are basically, in order to understand the pricing decision, we need to have the understanding of the price elasticity of demand. That is the fundamental to any pricing decision. That whether you need to see that whether your price the price of your product is sensitive, the demand of your product is sensitive to the price or otherwise. There are certain products whose demand is sensitive to the price, whereas then the other there are the products or services which are not sensitive to the price. Demand remains the same no matter how much you charge, right? In your case, the demand is sensitive to the price. How much is the price elasticity of demand? We don't know. Price elasticity of demand tells the percentage change in quantity demanded vis-a-vis the percentage change in the price, right? That is called the price elasticity of demand. The price elasticity of demand will be affected by the brand loyalty. The people are loyal to the brand, they won't change. Availability of information, proportion of income spent on commodity. If it's a small portion, you won't care. Time frame, price, then the availability of a substitute. Those would be having a impact on your price elasticity of demand. Then, after understanding this concept, the basic concept of price elasticity of demand, we need to have an understanding about the pricing strategy. The pricing strategy, you could have the various type of the pricing strategy. uh, there could be a pricing strategy based on the cost. This is no more in uh, is no more applicable. It is applicable only in the government projects, where the government give you a contract. They tell you that what is your cost. We will give you 5% on top of that cost. But normal market, the price is determined by demand. Like if demand, there's a demand, price would be affected by it. High demand, high price. Competition, your what is the how the competitors, what is the price given by the competitors. So in order to beat that or to manage that, you will be giving the discount. You could go for the premium if it is your product is differentiated. Then now this demand base means that if high demand, you could go for price skimming. Demand, you need to raise the demand, you could go for a penetration pricing strategy, right? So at initial phase, if your product is being weighted by the market, you could go for price skimming. Now the competition base, there is a competition, that you need to survive in the market. What these telecom are doing, they are doing the discount. But then a competition beast means that premium, if you are a differentiated product, you could go charge the premium. In the cars, like some of the cars are charging the premium because of their brand, because of, although they got a good competitive position. Then the other type, like the target value based psychology, depending on the customer segment, etc., like you could charge the various type of the prices. So your company is charging the premium pricing, high quality, high price. That is your strategy. Then pricing strategies are affected by another thing, like the at what stage of the life cycle your product is. And that would be defining that what strategy you could use for your product. That is important from the case study perspective. Again, you would know that your product is there at a maturity level, so you should develop, then you should suggest the pricing strategy accordingly. So in a development stage, sales are slow, competition is low. So pricing strategy is marketing or price skimming. We studied about that demand based. Growth is at a growth stage, sales are heavy. There is some competition. New entrants are entering into the market. So you could go for competitive pricing. Competitive means that we studied here competitive, competition, discount, premium, depending on the nature of your product, right? Then maturity, you have reached to a maturity, competitive or discount, right? And decline, discount or bundling. Bundling, you offer your product with some other product. The same idea has been explained here, that that at a product life cycle, you could see that what type of the price you're gonna offer to the customer. These you learned about these demand based, competition based, cost based, introduction value based, right? The value for money, like you should be. It again depend on the type of the project. Price bundling concept is you guys must have seen that that with the milk they are giving a free tea bags, the pack. So price bundling is a tactic of marketing two or more product and services for a price below the sum of the individual prices. You can do that in your company. You must be doing that in the low season bundling, like the ticket and you are already selling the package, so that is already the bundling, price bundling, and that's a way to give the convenience to the customer, and the price would also be lower because we have been told in the pre-scene your price of the package is lower than the individual sum of the individual price of the price of the individual product services. Loss leader is uh, basically these low cost carriers are doing this, Ryanair and Air Arabia, and there are the other airline. There would be other the businesses as well which are doing it. The basic product is so cheaper, but for that is the basic product with the basic attributes. Now in order to get anything more you will have to pay, and where they would be making the money, they will sell you a ticket very cheap, without baggage, without meal, without any priority on the seat. But after you buy it, now you want to, if you happen to get some baggage, they will charge you high. If you want to have a food in the airplane, you will have to pay for that. That is called the loss leader. On a basic price, a basic product, not charging high, but then charging for the additional services. Now, this was about the the pricing, because the revenue side and now the cost side both are covered. Cost was ABC, project appraisal, cost, relevant cost, and the pricing strategies, that is about the revenue. Now it goes towards another aspect, which is the behavioral aspect of the organization responsibility center. Your organization is divided into the different departments, and that the sum of the departments would be generating the profits, other are just incurring the cost. So now there is a concept of the responsibility center. You remember that we learned about the performance, the controlling performance. Now the responsibility center and controlling performance are linked with each other. We we segregate the organization in departments so we could uh, manage their performance effectively. So in organization there could be the different responsibility centers. In your organization, happy well, you do have the responsibility centers, aviation, booking, hotels, outbound the tourism management. So that some of those divisions would be cost center, the other ones would be profit center or the revenue center. So the concept of what is this responsibility concept, that in a cost center, the manager is responsible for only the cost, because he cannot control the profit, he cannot control the revenue. So this actually tells us about the controlling performance as well. So cost center, then the revenue center responsible for the revenue generation only. So accordingly, now depending on the nature of your department, you would be held responsible only for that aspect which you can control. That is the basic idea of the responsibility center. Then the profit, for your profit, you are responsible for profit. Investment center is the highest level. We are responsible for the cost, revenue, profit, and you could make the investment as well. By the way, in a cost profit center, you are responsible for the both cost and revenue as well. But in a cost and revenue center, here you are responsible for cost, here you are responsible for revenue only. When we are talking about the responsibility centers, we would be evaluating their performance. Those could be used on the basis of the various that if a department is a profit center, you could evaluate its performance on the basis of the profit it is generating. In a cost center, you would be having the different KPIs, cost efficiencies, how much the per unit cost had the that that what was the per unit cost, and what was the target, and what is the actual. Similarly, for the investment, what is the the return on the various investments that have been made by that the division or the department. Now another now the measure of measure to judge the performance of these responsibility centers, the benchmarking. Now when we say that there is a target of cost per unit, for instance, for a cost center, how are we going to know that this is the the standard, and we need to compare our cost with that standard? That would be coming from the benchmarking. From benchmarking, you could do the internal benchmarking with internal. One department's output is compared with the other department external with some other company. And then the process, there could be process benchmarking, that on the basis of the type of the processes, you could do that. For a hotel, like you are not a hotel company, you have the hotel, you own the hotel, you are basically a tourism company. So you could benchmark the processes of your hotel with some five-star other hotel, good hotel, performance benchmarking, and then strategic for the strategies. You could do the benchmarking. That will be giving you an idea that how you will be, uh, you know, comparing the performance of your department with the other department, responsibility centers with the other responsibility center. I have not gone into the details of the financial performance indicators because those are covered here in the balance scorecard. You would, in a balance scorecard, the idea is that if you would be evaluating the performance of any organization or any responsibility center just on the one aspect, that would not be helping you. In order to effectively measure the performance of any responsibility center, we need to look into all the aspect, the financial aspect, customer aspect, innovation and growth perspective, and internal business processes. There might be certain responsibility center where all of these would not be applicable. So you will see that which one is the relevant, and accordingly you could evaluate. So when it comes to the financial performance, it's about the profitability, return on capital employed, and the return on equity, credit, incremental cash flow, profit margin, you name it, like so many financial perspective. Then the customer lead time, increase the satisfaction of, in your case, the number of complaints could be a customer perspective. Like if bringing the number of complaints to zero, let's suppose, that's that would be telling you that you are, or you are, what is the trend of your customer complaints on the various services that are being provided to the customer. Or sometimes these hotels, they give the card which gives where the customer gives the feedback. Innovation and growth, that it again depends on what type of the nature, business nature you do have. Accordingly, you would be introducing the innovative processes, innovative active, the ideas. Internal business process, time taken to complete a customer request, utilization of the resources, that is the internal that is the internal business process. Now, uh, that was about now the behavioral side, the performance side, how you could measure. We studied about the performance in your managing performance as well. Now here we are talking about that how we could measure it in a production or a business operations environment, right? There we were focusing more on the human side. Here we are talking about the business side, right? The same thing, but therefore the indicators are different. There the indicators were different. Here the indicators are different. Then now comes the idea with the responsibility center. We know that when our organization is divided into the SBUs or different department, then there are the obviously this is inevitable that they would be interacting with each other. They would be doing the services for each other. Then comes the concept of the transfer pricing. That is again a way of one of the way of aligning the objective. Remember, aligning the objective of responsibility center with the objective of your company, corporation, or the organization. And the other is to evaluate the performance. You do have five, four, six department in your company. Some of those are cost centers. So how you will evaluate their performance? That could be then determine that whatever their output is, that how that is being measured. So a value tag is could be attached to that. So one department producing something which is being transferred to the other, the organization want that the internal departments or SBU should buy from the internal department divisions. If one is producing and the other one is producing, buying, other one can buy from the outside as well. The buying department, the selling department can sell outside, but the priority is that they should do the internal buying and selling. So when they would be doing that, because their performance would be evaluated separately, so there has to be a rule to do that. That is actually called the transfer pricing. This whole idea called the transfer pricing, that how you will be determining the price of that. Now the transfer pricing could be based like the transaction which are being done between the department and the division could be done on the basis of the various the techniques, market based. It depends that the if your product can be selling, department's project can be sell outside or not. and whether they do have the capacity, spare capacity or not. On the basis of that, market based, where whatever the market, if you sell in market in $10, but the distribution and selling cost is $1, internally when you would be selling, you won't incur the cost, the distribution selling. So with the adjustment of that, you will sell it inside. Marginal cost, whatever the cost you are incurring, you would be adding to it, and that marginal cost, that whatever the incremental cost to produce that product internally, that would be charged to the other department. It depends. Then if you have a spare capacity, then you will do that, because you can't sell it outside, so marginal cost. But it doesn't work, because in marginal cost, the selling department will not have the incentive, so you will have to give them some incentive. Full cost, whatever the except the selling cost, whatever the cost is being incurred, that would be charged to the other department. Now you should understand that the selling department, the price is a revenue for them. Buying department, the price which of the transaction is a cost for them, so they will try to bring their cost down, you will try to increase your revenue. So there has to be a balance. So these are the rules which would be creating the balance. And then cost plus markup, that again work in or government organization, where there is a cost and they could tell you that you could add the markup 5%. Negotiated, the two departments talk to each other and they strike a price, they decide a price. That these are the some of the the ideas that could help you to determine the transfer pricing between the two departments of the same organization. Or there is a group and there are the two subsidiaries of that group, they shouldn't do the transaction among themselves, because that is beneficial for the company. So sometime if those divisions cannot resolve their problem, the head office will interfere and they will do that, right? So this was about the idea about the transfer pricing. Transfer pricing is an important topic that has been tested a numerous time in exam. After that, that now the responsibility center and transfer pricing, these are linked concept. We studied about the cost related projects, those were linked with each other. Then we studied about the pricing strategy, that is another concept, right? Now about the risk. Now there is a concept of the risk and uncertainty. Risk can be measured, uncertainty cannot be measured. Risk and probability can be associated with the risk, and uncertainty is something which cannot be measured. Again, you cannot know that what are the chances of that event to occur. So risk approaches. Now, how much risk is something which is undesirable, then why the organization are taking the risk too? They are doing it to gain the competitive advantage. Without taking the risk, they cannot get the returns. Then risk approaches, that it depends on the organization, that with how much risk they want to take. Like the different organization have the different risk appetite. Like the individuals, some people are take so adventurous, they take the risk. Otherwise, so they don't take the risk. So risk neutral is the guy who is not like he would be doing the thing if the risk is minimal, or they know for sure that this is the risk. Risk averse is that the guy who doesn't or the company who doesn't take the risk at all. Risk seeker, the adventurous companies. It is your what we call that Elon Musk. He was left with $200 billion, I believe. So when he was doing the last project, his last SpaceX, he was told that if this time this project fails, you would lose everything. You would be on the road. So he took the risk. He said, "Okay, this is my the dream." So they did that, and that was successful. So he took the risk, and he that he succeeded in it. So in order to measure the risk, that what are the techniques which could be adopted? You would be doing the scenario analysis and sensitivity analysis. There is a difference between scenario analysis and sensitivity analysis. Whenever you are doing a project, you would be preparing some model, Excel model. That these financial models, there would be certain assumption in it. Like in your case, if you are going for a 5-year business plan, you know that you don't know that what would be the fuel price in the next 5 year, what would be the prices of the various commodities, what would be the the price of your packages. So you will make some assumptions. On the basis of assumption, you will make your projections in order to know that how the things would be going in the future. Now in sensitivity analysis, let's suppose that you have taken the assumption of the fuel price for $90 per barrel. Now in sensitivity analysis, you will see that your management will tell you that what if the price goes up to $100. So you will change that $100 and you will see that what is the profitability. Your company is still profitable or not. And if you are doing the investment appraisal, you could see the NPV or IRR. that whether still the NPV is positive or negative. Scenario is more like you would be clubbing together the various scenarios, and you will be doing that, that various assumptions together, and you will run that to see that what would be the impact of that scenario. Like you will be changing the fuel price, you will be changing, let's suppose that the prices of the other commodities as well, and you will take that, because of the inflation, the buying power will go down, so the price that we are assuming that will also go down by 5%. Now you will change all these three things, and that would create a scenario, and you will see the impact. This minimax, maximax, I'm gonna leave it. Then stress testing is very important. That is has been tested, like in order to know that how resilient your company is. Resilient mean that how good prepared your company is to respond to a situation, an uncertain, a risky situation. You could do the scenario analysis. So scenario analysis, sorry, stress testing. In stress testing, they says that that if you know that in your company what are your priorities, you are very clear, you know your customer, you know your priorities, then you are well prepared. Then measurement means that if you do have the KPIs, well defined KPIs, or the idea is that if you know the business, then you would be prepared. Then you could manage it. The measurement is that critical performance variables are meeting customer needs. So if you know that, you will be taking care of that, and you could manage it. Then in a happy well, again, I have linked it with a happy well, although we will do it later in pre-scene too. Happy well is measuring these factors through the feedback of customers, so they know it. Measuring, prioritizing, measurement, productivity, how you are generating the creative productivity, like how productive you creative your organization is. You know that you are inquisitive, you are your company uh, is coming up with the creative ideas. There is a healthy conflict between the the people working there, healthy conflict, that is refining the solutions. So that's called the productivity. Flexibility, that that your how adaptive your company is. Again, that depends that what type of the human resources you do have. You are a digitally equipped company or not. If you are not, then probably you would not be able to adopt it. Then this is the risk management cycle. In a typical risk management cycle, you will be identifying the risk, you will assess its impact, mitigation. You will be developing the mitigation plan, implement it, and manage it. So cost and benefit, at the heart of this whole process. If reducing, you will see that what is the cost of the risk, and you will see that what is the cost of reducing, or making the mitigation plan for that risk. If the benefits of reducing the risk are more than the cost that is being incurred to reduce that risk, only then you will do. If the cost to reduce a risk is higher than the actual cost of that risk, then you should not do that. Cost and benefit is very important. um, Risk management strategy, again, that this way, that would be defining the at the top level risk capacity of the organization, at a strategic goals like capital, like how much the value of your company is actually. So that would be defining the risk capacity. If you are the paid up capital or your company's cash flow, that would be defining capital resources, would be defining risk capacity. Appetite, management would be defining that how eager they are to take the risk, they are risk averse, risk neutral. Then the risk tolerance, you will be having the determine the various type of the strategic risk, compliance risk. We will not go into the details of the risk. Again, you need to have a just a brief idea, because risk management is a is a complete subject at strategic level. So there you we will go into the details. Risk target, and then that the risk limits for the different department. This is the risk pyramid that comes from the top to the down. Risk framework, Tara, on the basis of the impact and the probability, you would be making a strategy. If there is a risk event which has a high impact, and there's a probability it will occur, high probability of its occurrence, avoid it, because it will, that it will go beyond your risk capacity. So you won't be able to manage it. Then, if the impact is low, probability is high, reduce it. We generally, this is the case, like we reduce the risk. and they or we transfer the risk. Transfer the risk like airplane for the happy well airplane crash is a high risk event. Its impact is high, but the airplane is a very robust machine. The chances of its accident are lower. So what you do, you get an insurance transfer. You have transferred your risk to somebody else, right? So then the fundamental ethics of fundamental ethical principle. These would also become a source of risk if those are not complied. Integrity, objectivity, professional competence, confidentiality, professional behavior. Let's suppose that the information of your customer is not is being secured, so that would become a risk point for your company. So the non-complying, not complying with the fundamental ethical principle could also become a source of your risk. Then data protection is another source of risk. Nowadays we are getting a lot of data of customer. Your company Happywell is also collecting a lot of information of your customer, their passport information, name, payment information. That there's a lot of information that is being flowed to the organization every day. So we have an understanding of this big data concept. Big data means that a data with a high volume, huge volume, variety of data, value with a great value attached to it. It is changing so quickly. Knowing the authenticity of data is a challenge. So big data, managing the big data is the core for the organization. Nowadays, that this data is the new gold mine. So organization even acquire the other organization just to get the data. So data protection is very important. This data, where this data is so important for your business. At the same time, data protection failure to protect the data could become a big risk for your company. So that's it from this chapter. Again, it took us a little longer. I was targeting to finish it in 50 minutes, but it took longer. Okay, Ji, any questions?